Okay, good evening, guys. This is your Silver and Tremaine Founders Platinum Leader with I Am Mastery Academy, and today I want to just introduce the Harmonic Scanner to you and a simple strategy that we use to help persons to understand uh, to be able to get good trade opportunities from the scanner. All right, now the scanner is an automated tool using Fibonacci and Elliott wave techniques, is built-in algorithms that the company has put together over 16 years. This scanner was created. It was one of the first flagship products of the company, and it's a highly successful tool, has a high win rate. All right, and this version is the latest version that the company has to offer. Essentially, the scanner, this is the interface here, and the scanner has a win rate of about 80% thereabouts. But you do have to be able to identify winning trades off of the scanner. If you take trades flush from the scanner, you could find trades that are not winning because the scanner doesn't take into consideration certain things such as news, all right, and therefore you could find yourself in a situation that you take a losing trade from the scanner. All right. But with proper risk management, you will be able to have a profitable experience with the Harmonic scanner. Now, there's a desktop version of the scanner that you could install to your MetaTrader 4, but this version is a web version. So I'm going to kind of explain the interface, and then I'm going to show you a simple strategy that you can use to allow you to help you to win with the scanner. All right. So without further ado, let me get into the details. So when you log into the scanner, this is the interface here. It integrates Trading View interface into a software. I don't want to call it a shell, but it's a frame, right? And this frame is the company proprietary interface, right? There's different products you could tap into directly from the frame, and also the scanner pulls data from different brokers. So there's different brokers you can choose so that you could find investment opportunities from those brokers in different time frames. All right. So the time frames here are 15 minute, 1 hour, 4 hour, and daily time frame. So I usually go with the 1 hour uh, signals from the scanner. So when you look at the opportunity, when you interface with the information from the broker, uh, the the information in terms of the opportunities coming from the scanner with the particular broker data, you can see that the pairs are here, right? Usually there's some things you must consider, right? Obviously, if you're trading a certain session, like let's say the Tokyo session, you will be looking at pairs as relevant to that session, all right? So the yen pairs, Aussie pairs, right? New Zealand, and so forth, right? That's one thing. Also, you want to be you want to practice proper risk management, right? So you want to understand how to read the scanner and know what's the risk and what's the reward required per trade. All right. So to understand if the scanner is saying buy or sell, the first thing you look at is you can look at it different ways. You can look at where the entry is relative to the stop loss, right? So once you see the entry above the stop loss, that means that the scanner is suggesting a buy, right? The price is expected to go up. If the stop loss is above the entry, then it's expected to do a sell. Another way you could look at it is you could look at the this pattern here, right? If it's from the X to the A to the B, B to the C, and the C to the D. If it's shaped as an M, then it's saying to buy. If it's shaped as a W, it's saying to sell. So let me see if I could pull up an example of the sell compared to the buy, right? So, right, so here we see that here was a sell, right, where the shape was X to A to B, B to C, C to D. That's a W, right? So it's saying to sell in that case. If it's a M, it's a buy. All right. Now, how the scanner works is really simple. The scanner scans the markets, and usually it'll just be like this: a plain market data, and then when the scanner finds an opportunity, it's going to produce the scan like that. It will appear, and it will appear in your menu so that you can choose it as a possible opportunity, right? Now, there are take profit levels associated with the scan. So you have your stop loss, your entry, and your three take profit levels. All right. I usually work with take profit three, nothing less. All right. It's either I win the trade or I lose the trade. You could take profit one and two, or you could twin trade the trade or triple trade, and you can simply take one trade to take profit one with probably a larger lot size because it's a lower spread, a lower distance. Then you take profit two, smaller lot size, longer distance. Take profit three, even smaller lot size, even further distance from entry. All right. So you can do it that way. So that is essentially, in a nutshell, some of the key information with regards to the scanner, the harmonic scanner as we call it. All right. Now, the thing is, what I do is I simply reproduce the scanner on TradingView, and then I apply the strategy and the checks and the criteria for taking the trade. Right. So what I'm going to do is share what I call the smart money harmonic bounce trap, uh, otherwise known as the SMHBT. Right. Smart money harmonic bounce trap. All right. So let's see an example of a trade I could look at and possibly apply this strategy. All right. So let's see. All right. So this is the CAD JPY. Right. CAD JPY. So let's go. This is a live trade, CAD JPY. Let's see if we could find CAD JPY. I'm going to look at it on the 1 hour time frame. All right, so let's see if we could reproduce scan. All right. My battery has. Right. So we're gonna see how we could reproduce this. So the scan started around here. All right. So let's see if this is a scan. Yeah, this is just about the scan, right? And then let's see, it has a stop loss of 82.901. 82.9901 red. That's my stop loss. My entry will be 83.022. All right. And my take profit 3 will be 83.650. All right. 83.650. That's my take profit 3. All right. So we're going to apply a simple strategy to help understand, whether to take this trade or not. So first of all, let's look at the name of the strategy. It's called the Smart Money Harmonic Bounce Trap. So each part of the name is associated with a check on the scan to see if it fulfills the criteria. Right? The first check is a smart money check. right? So the key things that we check is areas of imbalance above and below the scan, the pattern. Excuse me. Also, we check uh, for equal highs, and equal lows on the pattern. Meaning if the pattern, part of the pattern has formed equal high and equal lows, right? So let's look at that first check, right? Smart money check. Smart money check. All right, so let's take a look at this, right? Now, to understand the smart money check, you need to understand smart money concepts, right? So I'm not going to go into the full details of it, but generally speaking, just to give you an overview, all right? Let's delete some stuff. All right, so I'm looking at price history above and below uh, the pair that I'm looking at, right? So let's see. All right, so above the current price, I'm looking at these areas here. So this is a 4-hour time frame. So what I could look for is clear areas of imbalance, we call it, above and below the current area of interest, right? So because I am not seeing, well, there was balance taking place here, right? Because the price came here and it balanced. But here, if we look at this candle here, we see some imbalance. Now let me explain what imbalance is, right? This candle here, we see some imbalance here, right? So let me explain what it is. So simply put, big institutions like big banks and hedge funds manipulate the market, right? The retail traders don't have much power to move the market. The uh, big money, as we call it, smart money, they have the control of the market in terms of the volume that floods the market. So what they do is when they're doing their orders, they actually seek to get their orders at a major discount. So they take advantage of the retail, the data coming from retail traders to be able to set up their own setups, right? And so that do their own buys and their own sells. So for example, if I share, what they do is, for example, they will set up price in a way. Well, let's say they want to do their their particular trade, right? They want to do their trade. So what they will do, they will send the price up in such a way it will motivate uh, retail traders, right, to get into uh, a buy, right? But there's a number of things they'll do. Let's say you have support and resistance here, right? What happens is when retail traders see this, they see price bouncing off a support, right, or a resistance. Sorry, a support, a resistance or a support, right? So let's say this is your resistance, this is your support, right? You know, you have your zones and stuff, right? You have your zones to cover the area, right? So you have your zones and stuff. But the thing is, most retail traders, what they will do is that they will they will sell at this point and they will buy at this point, right? But what the smart money does is essentially they understand that retail traders in selling here, they will set their their stop losses above here, right? And when they're doing their buys, they will set their stop losses below here. So the thing about it is that the average retail trader puts about 30 pips risk, right, from their entry. And because millions of retail traders are doing this, uh, the smart money actually knows how to actually manipulate the price to hit your stop loss and your stop loss, basically, right? Hit your stop loss, whether it's a buy or a sell, right? So what they will do is they will push the price up, right? So let's say they know that they set up this here where people are selling off of this resistance, buying off the support. They'll push the price up into uh, at a height where it will be too much for the average retail trader. So let's say 100 pips or something, right? The average retail trader will not have a stop loss of 100 pips. And then they will do their sell, right? So everybody who had their stop losses within this space, their stop losses were hit. And when your stop losses hit, essentially you sell back your position or buy back your position to the market. So the big players they get their price at a discount and then they do their sell, right? Similarly, if you enter a buy, they can stop out the persons in the buy, right? And then do their buy. So the thing about it is that smart money will actually set up situations like this where they will lull average retail traders into a false sense of security, buying and selling. And then they will do these huge spikes to stop out traders, right? But when they do it, it creates a certain level of what we call imbalance. And what imbalance is basically is that let's say you have how do they stop out all those retail traders? They will push the price up, right, with a huge candle, right? Or they'll push the price up, and the last buy candle that they use, right? What will happen is they will hit the stop losses of the sellers, plus they will attract inexperienced traders to buy as well because the traders will see how the price move above this resistance here, and then they will send price back down, right? And many times when they do that, they will close off this sell. They will send the price back up halfway up on this candle, right? I don't have time to color the candles red and green and stuff, right? And then they will continue with their sell, right? But sometimes they don't they don't bring the price back up, and so they just continue with their sell, all right? And what happens is that they leave what we call imbalance, right? They leave imbalance where there's this gap in balancing, like closing off this candle. So they leave this buy open in order to manipulate price and then sell, right? But they have to close this buy eventually. So what happens is that they bring the price back up to the buy. So what we do, what happens is that we identify half of the body of the candle as well as the wick. So let's say there's a wick, right? We also cover the wick as any part of that area where price could come and balance, as we call it. Price could come back up and balance here, right? And then continue back down. So when price comes back up and hits that area, it means that it's balancing it's mitigating the previous buy candle here as going to sell. Similarly, for a sell situation and a buy, right? So there could be an open sell candle, and then there could be mitigation. Price could go back down, go to half the body of the candle, and then go back up, right? So having explained that, what we look for, let's say there's a scan, right? Right, there's a scan, sorry. Right, so let's say that's a scan, right? The things that I look for with the scan is to see if there's any area of imbalance, right, above or below, all right, above and below, so that we could identify this imbalance and identify opportunities, identify possible risk, meaning where even though the scanner might be saying buy, it's possible that because of imbalance, the price may want to go down, balance here first, and then go up, right? So that's the first thing. And what usually is a hint um, of smart money wanting to balance or to knock retail traders out, right, is looking for equal highs and equal lows. So let's say the scan was not like this. In this scan, this low is lower than this low. But there are some scans that could come like this. Basically, it's almost as though it equals, right? So it could qualify as equal lows and equal highs, or equal lows in this case, whereby the X and D are basically almost equal. And the reason why this is sort of risky when you have a scan is because retail traders know about patterns, right? And they know how to buy off of support and resistance. So with this support here, there'll be a false sense of security that, all right, once price reaches here, price wants to buy, right? Plus there's this pattern here. So now retail traders may be putting their stop losses on it here. The scanner and all will give the stop loss somewhere there. And people will have a source of false sense of security, so they may do increased lot sizes, right, in order to do this buying. But if I see anything like this, whether it's the equal lows or it could be equal highs like this, it could be like this, right? And when you look at it, right, if it was a sell situation, if it was a sell like this, if it was a sell, and I see equal highs like this, similarly, I'm seeing a risk, right? And the scanner is suggesting that we sell, right? I'm seeing a risk where the market could push upwards to balance here and then drop, right? So retail traders might just trade off of the scan, off of the sell here, stop losses around here. Now, if you see a stop loss that's above mitigation, above imbalance, well then maybe you can consider that safe in that even if the price drives up here and then drops, the stop loss is behind, is above this area of imbalance, right? So we do the smart money check. We check for equal highs and equal lows, and we check for imbalance to determine how risky it is to take these scans, right? If we go back to the scanner, we may be able to pick up one of the trades having equal. Let's look at USD JPY. If you look at USD JPY and you look at, well, this is a buy, right? They don't have equal lows in this case, so it's fine. But if you find a scan where it's a sell trade, it's a sell scan, and let's say these highs were equal, right? Then that could be more risky because then we could look above, right? This is the stop loss here. We could look above right here for some sort of imbalance, right? And price could go to that point first, balance, hit your stop loss, and then sell. In fact, let's see. Right? So it didn't do that in this case, but if it was equal highs, right? If it was equal highs, then it's a higher probability that this can actually go up and break this equal high, mitigate, correct the imbalance, and then drop and sell. All right. So having shared that, I go back uh to the pair. This is the smart money check. All right, this is the smart money check. So that what I shared there was a brief explanation of the smart money concept, right? So coming back to the scan, right? What we want to do is identify mitigation imbalance above and below the scan, right? So below the first area of imbalance that is of interest to me is this area here, this sell candle, half of the body. So I mark out that area, right? I look at the scan, I look at the lows, I see that the lows are not equal, right? I also look at the anywhere here, if there's any sell candle that had previous imbalance where this drop here may indicate that some form of balance took place, right? Or if we look at here, right? So we do have an equal lows situation going on with this area here, right? So price right now is in the mid-range zone here, right? So we want to mark off this zone, right? And that zone there, right? These are two important zones, right, with regards to this trade, all right? Because price could come up here and then it could drop and balance here. So what we're doing is we're looking at the smart money risk, and then I'm going to identify area above where you consider the same thing, right? So if we go here, we could look at this last buy candle here, right? Clearly a lot of imbalance there, right? We can also probably identify imbalance. Well, what we saw here was there was equal highs and price went above and then dropped, right? We saw that there. So there was some form of some form of mitigation taking place here, right? Right, so mitigation took place there. All right, so we saw that market balance at this point. So the other area of imbalance that we are most interested in is in this higher area here. So the question now becomes, what is the motivation of smart money, right? All right, what is smart money's motivation? Now, because this imbalance here, this mid-range area becomes important, right? Because as I said, um, price could be motivated to drop here first before buying, right? So we take a note of that. The next thing we're looking at is the bounce part of the equation, of the strategy. Now, I'm going to go down to a lower time frame, 1 hour time frame, and identify the prevailing trend, identify some sort of trend line that price will have to break. So if I go draw a trend line, we can see that we have a decent trend line here. The price should break to suggest a buy, right? Now, if you look at the zone is below this trend line. I'm going to come to the zone shortly, right? So we have the smart money check. We have the trend line. We want to add something called the EMA cross, right? The EMA cross. We have so many. Somehow sorry, not this one. All right, give me a second, guys. All right, so I just added the EMA cross, right? So how the EMA cross works, there's different ones, right? So basically, I use the default settings, and you're looking at the EMA, so the moving averages, right? Red and green. And when the lines cross, you get this plus sign, right, indicating that the cross took place. But there's another one. Let me see if I could find it. Right. EMA cross. Found it. All right, good. All right, so this one has right, they have multiple EMAs, right? And when the blue line crosses the orange and red, you get this crossover signal, right? So here, we saw it here, right? We saw here, it crossed over the red and orange, and this indicated that the buy was strong, right? The crossover here again indicate that the sell was on, and so forth. So what we're looking for is we're looking for the the blue to cross over the orange and red, and it's already pointing up. So you're seeing that it's imminent, right? It's looking like it's threatening to do it. So it's giving you more confidence that this thing is about to buy. So now this is the EMA cross along with this trend line is the bounce aspect of the strategy. All right. So this was derived from the bounce back concept of the company. There's a bounce back scanner actually. When you get a signal from the bounce back scanner, you are then asked to draw a trend line and then identify the MACD crossover. Instead of the MACD crossover, I'm using the EMA cross, right? It's the same thing when this happens. When you see this cross here, it's like the MACD crossover, right? I just like to have it this way. I can see it directly on the chart rather than trying to look at the MACD and line it up, right? So after that, we apply the trap aspect of the strategy. So there's smart money, there's the bounce, and there's the harmonic, as you can see, and then there's the trap. What is the trap? The trap is simply for drawing two zones, all right, at the where the harmonic originated in terms of the D point. You find a support zone there, and you find a resistance zone above that point where you actually identify an area in which price is basically trapped. And when price breaks out of that trap, you have an opportunity to confirm the buy in this case, right? So let us look at the fact that we have this area of imbalance here. The price trap gives an extra protection against price potentially going down to this point. So if price breaks above this zone, it's highly likely it's going to go at least to take profit 3, right? If it fails to pass this trend line, right, then even if it fails and it goes to balance, it has to pass this zone. It may do a retest and drop, right? Or it may just go straight down. So you can make money even though this set buy, you can make money on a sell if it breaks out of this trap, right? So essentially, the price trap now gives an extra layer of protection and allows you to make money either direction. Because at this point, the harmonic has failed, right? So then the sell is the high probability situation here, right? Uh, in this case, if it goes above this zone and it breaks this resistance zone and then it comes back down and finds support, then we're looking for the buy, right? And so the kind of pips we're looking for here is about a 50 pips. Let me just check to see take profit 3 on the scanner. Take profit 3 is 83.65, right? 83.65. 83.65, right? And that's how many pips? That's about 40 pips thereabouts. All right. And because we have this area, previous imbalance area that was balanced, I'll be looking for price to possibly go higher up to this higher area of imbalance, right? I may run a Fibonacci, for example, to see how relevant this area of imbalance is to the overall chart. Right, so I look for a previous high, like here. I run the Fibonacci, and I see that this area of imbalance is around the 62% area. Now it did reach back up to the 62% area, above the 62% area, right? So it could very well be that it wants to go higher than the 62% into this area here. All right, this 79 to 71% area. All right, so I use Fibonacci as a way to gauge how far the market wants to go as well. I also look at the overall market trend, but overall, that's for longer term trading. At this point, I am just interested in 50 pips, just about 40, 50 pips, right? I'll also take note that this thing is on a trend, right? And so far it's holding on the trend, and the scan is basically on that trend, well, almost on the trend, right? Let's see if I could draw this trend a little better. Right? Just hold on. All right. So if we look at the trend, we could see that possibly price may want to go a little lower and meet that trend line, right, before going higher. So that's why we have to wait on price to break above this zone to give us more confidence to take the buy up to this point. Even after up to this point, it could still go back down to touch this trend line before really going up. So the smart money harmonic bounce trap is really an effective way to protect your money against losses when you're taking a trade from a scanner. It can take you a little while to really grasp it, but essentially it's a powerful strategy that works, right? So the criteria is smart money check, areas of imbalance above and below the pattern. We're looking for equal highs and equal lows to avoid trading patterns, right? Then we look at the bounce check, right? Which is basically the trend line on the time frame of the scanner and the EMA cross, right? The EMA cross has 4 EMA time periods, including the 200 EMA, right? We're looking for crossover of blue line above or below the orange and red line, right? And the last check we have is the price trap, originally from Christopher Derrick. Create a support and resistance zone around price at entry of at price price at entry. Right, so this is the smart money harmonic bounce. Right, let me just probably make it smaller. So those are the tips there. Right, and this is just how it looks at the end of the check. And right now, this is CAD JPY. If this thing breaks above this zone, it breaks above the 83.306 level, then we're looking for a buy up to 83.65. Right, so guys, this is just a sample of a strategy used on the harmonic scanner. There's many other strategies. You can go to the I am Go Live sessions. Look for the educators. I'm not an educator, but I just use a combination of strategies used by a couple of educators. Price Trap is from Christopher Derrick, right? The Bounce Back is from Stevenson Lindo, right? Smart Money is from the Trade House team, right? And if you look at this channel here, we see that price was bouncing around in this channel, and price is expected to go back up, right? If it continues in this trend, it will go back up into the 71-79% Fibonacci belt, which is consistent with the buy here with this particular scan. It could come back down to the support line of this channel before it goes up, but I'm favoring the buy for this particular pair. All right. So I want to thank you so much. I look forward to serving you and helping you win in 2020. We are going to break 20, at least 20 six-figure earners in trading this year. But we are looking for more than 20. So if you want to be a part of this movement, feel free to connect. Feel free to connect, right, with anyone who is sharing this particular video with you, right? So take care and God bless.